This is the final day of September and the final day of the quarter. And boy, the bulls are glad to see this September go. It looks like this is going to be the worst month for the stock market in terms of the S&P 500 since early 2020. Let's talk markets with Jacob Walthour. He's the CEO of Blueprint Capital Advisors. So thank you for joining us, Jacob.
Thank you, Conway. Good to be with you again, and thanks for having me on.
Great. Listen, we're seeing the market fall, excluding the Nasdaq. Really, the Dow down like some 400 points on this day. This is the final day of the month, final day of the quarter. What happened to the window dressing?
Yeah, we're not seeing window dressing at the end of this quarter, and window dressing is really all about professional portfolio managers looking good for their investors, and that means they're going to sell their losers and migrate capital towards their winners. And so it looks like from a portfolio perspective, the portfolio is better positioned going forward, and hopefully that leads into the retention of those investors. I think this time around, portfolio managers are paralyzed. They're not really sure how to interpret what I'll view as conflicting data. I think overall, people are staying invested, which means they have a long-term bullish sentiment on the market. But I think short-term, they're looking at this data. Let's take, for example, initial jobless claims. That number came out today higher than expected. Now you have to ask yourself, with record high job openings, and I think that number is hovering around 10 million, and roughly 750,000 jobs being added to the economy in the US over the course of the last 3 months, why do we have an uptick in initial unemployment claims? Especially given the fact that all of the assistance in the form of enhanced unemployment benefits coming out of Washington have ended. And so when they're trying to interpret that kind of data, it doesn't necessarily give you enough direction in terms of which sectors or which companies you should favor and which ones you should de-emphasize on a going forward basis. I think in the backdrop of all that, you also have another round of dysfunction in Washington. Here we are talking about another shutdown on the part of government. We're trying to raise the debt ceiling or at least have a temporary solution here to avert a shutdown. The Fed is talking about tapering, which means, sooner or later we're going to talk about, raising interest rates, and that cascades through in the form of higher borrowing costs. So I think with all of that data out there, basically it's going to take next month's earnings season to stabilize the market and get people excited again about a broad recovery at the company level.
So as you know, I like to talk strategy with you. So let's talk strategy. Last time I had you on in April, you said that you were bullish on the banks shorter term, but you were concerned about the financial sector longer term. So now here we are 6 months later, and I'm wondering how you're feeling about the financial sector, especially given the fact that now we have interest rates finally moving up, but it seems like fintech is coming on pretty hard.
Yeah, fintech is coming on strong. I was constructive on the banks about 6 months ago. And there, what I was looking for was more of a cyclical recovery. From a long-term perspective, I expressed my concerns, and I'll be completely honest with you. While I think the banks are very healthy from a balance sheet perspective, while I think they're starting to put more loans on their book, and certainly higher interest rates will lead to better margins on the part of the banks, I just think they're boring. And I don't have any high expectations that having them in a portfolio is going to lead to above average results. And so while I think that they're healthy, I just don't think that they're the best play right now if you're putting fresh money to work in your portfolio. I do think there are other financials that are much more interesting to me. So for example, MasterCard and Visa. We're coming into the holiday season, and I fully expect that people will be shopping remotely and using their cards, and that obviously is going to benefit MasterCard and Visa. And so if I'm looking at financials right now, I'm probably favoring situations like those over the big banks.
And real quick, talk to me about technology. When I had you on in April, you said that you were looking for a benign correction and that you were going to do some buying. We got the Nasdaq down about 5% this month. Is that enough of a benign correction? And what are you buying?
Sure. So let me just be really clear. whenever money comes in, that money should be directed towards companies that you think are disruptive, companies that you think are sustainable, companies that are dominating their industry, and quite frankly, companies who are changing industries. And so for that reason, even if there weren't a benign correction right now of 5% over the course of the last month, I would still be excited about large cap tech names. But having said that, there's nothing wrong with buying them at a 5% discount. I think 5% is enough. I don't think there's anything in those companies' operating situations. They're not experiencing their own little private bear markets. And so I happen to think that the marketplace is giving you a 5% better entry point for a lot of those big tech names. And in some of those names, you're actually getting a much larger entry point. So I continue to be bullish on tech. I probably will be continuing sort of my bullish stance on tech throughout 2022. And when I'm venturing from tech, I'm looking at companies who are being more tech enabled. And so I like Lowe's, I like Home Depot. I think they've done a good job of converting their business models from being big box to now offering more of an online opportunity. I continue to be super excited about Amazon as we come into the Christmas season. I just don't see people with the spread of the Delta variant taking that risk, going back into malls. I think they do most of their shopping online, which obviously benefits Amazon and other people who have done a really good job of e-tailing. So over the course of the last 6 months, not much has changed from my perspective. I'm still very, very positive on the overall market and still, as positive on my tech names.
All right, great. That's Jacob Walthour. He is the CEO of Blueprint Capital Advisors. I'm Conway G. Gittins, and this is Reuters.
Will you commit to ending Finsta?
Senator, again, let me explain. We don't actually do Finsta. What Finsta refers to is young people setting up accounts where they may want to have more privacy. You refer to it as privacy from their parents. What in my interaction with teens, what I found is that they sometimes like to have an account where they can interact just with a smaller group of friends.
Well, Finsta is one of your.
We've actually.
Finsta is one of your products or services. We're not talking here about Google or Apple. It's Facebook, correct?
Finsta is slang for a type of account.
Okay, will you end that type of account?
I'm not sure I understand exactly what you're asking. What I can say is that based on what we've seen in terms of teens using those kinds of accounts, we've actually given them additional privacy options to address those kinds of issues where they want more privacy so that they can have more privacy.
Well, I don't think that's an answer to my question.
A rough finish for a tough month for the stock market. September came to a close with the biggest monthly drop since the start of the health crisis. The Dow tumbled 546 points on Thursday. The S&P 500 dropped 51. The Nasdaq fell 63. For the month, stocks were down nearly 5%, the worst monthly drop since March 2020. Investors nervously watched as political debate continued in Washington over the debt ceiling and President Biden's signature infrastructure spending plans, even though a government shutdown has been avoided for now. The third weekly rise in first-time applications for jobless assistance also spooked the market. Initial claims for unemployment benefits rose 11,000 to a seasonally adjusted 362,000 for the week ended September 25th. The number caught Blueprint Capital Advisors CEO Jacob Walthour off guard.
The initial jobless claims numbers being up, I must admit, was a complete surprise to me. Given this backdrop of 10 million job openings, almost every place I go, from Popeye's fried chicken to Starbucks to local mom and pop smoothie shops, have help wanted signs in their windows. And so it was really a surprise to me.
The Labor Department cited a change in the way California is classifying the unemployed. Economists believe the labor market recovery remains intact despite the recent uptick in unemployment claims, which is also being tied to workers scared to go back to work because of the health crisis and those who would rather get fired than get the vaccine. In individual stock action, shares of Bed Bath & Beyond were hung out to dry. The retailer missed quarterly sales and profit forecasts and slashed its full-year outlook, citing supply chain disruptions and a slowdown in consumer spending due to the health crisis. The stock lost more than 1/5 of its value in just one day. Kohl's was another retailer slammed on Wall Street. Bank of America downgraded the stock on fear that supply chain disruptions will hamper the department store's recovery. The stock was down more than 12%.
Factories in northeast China have warned their businesses won't survive if authorities continue with crippling power cuts. Beijing is scrambling to deliver more coal to utilities to restore supply. The worst cuts in years have hit 3 provinces in the region, home to nearly 100 million people. Gao Lei runs a laundry processing factory.
Electricity is really important to us all in our daily lives and to small companies like my own. We aren't even a small company, we're just a processing factory. Anyway, I think as long as we can afford it, we are willing to cooperate because the country needs it. But if power curbs continue in the long run, we have to think of a way to deal with this.
Wang Jianjun, who manages a steel treatment centre, says he's concerned about the continued halting of production. I'm really worried if power curbs will happen frequently in the future, he says. We can't work if there are more power curbs. Since last week, more than 100 companies ranging from makers of electronic components to gold mining have suspended production over the cuts. The shortages were triggered by a surge in the price of coal, which generates about 2/3 of China's electricity. It's now hovering near record levels amid tight supplies and strong manufacturing demand. The government has said its priority will be to guarantee household power and heating supplies over the winter. Truck drivers have a warning for British Prime Minister Boris Johnson. Prices for everything from food to Christmas gifts will rise. An air of chaos has gripped the world's 5th largest economy in recent days. A lack of truckers has left fuel pumps dry, and a spike in European wholesale natural gas prices tipped energy companies into bankruptcy. The UK is short of around 100,000 truck drivers. Tens of thousands returned to the European Union after Brexit. Miguel Brunel is a truck driver from France.
This is what they wanted, and it comes back to this. All the foreign drivers they had, and even the English ones they had who left, now they can't employ them anymore, and all these problems, it really is their fault. If they had managed to keep more British drivers on their books, they wouldn't be in such a state.
The shortage was made worse when 40,000 truck driver tests were cancelled during the health crisis. At one British service station, scores of drivers told Reuters that wages would have to rise.
This job is hard. Well paid? Well, what can I say? Not really, since I work 13 or 14 hours a day. Like it or not, but 13 or 14 hours a day should be paid better.
Some investors are now questioning whether the world is on the cusp of persistent price rises after the splurge by governments and major central banks to deal with the global health crisis. Haulier companies and recruitment agencies are battling to fill trucker jobs. One was advertising for a heavy goods vehicle driver for £75,000 or $102,000 per year. The government has plans to issue temporary visas for 5,000 foreign truck drivers. But none of the drivers interviewed by Reuters thought many would take up the offer.